Hello, and welcome to the FEI Houston Chapter CFO University Conference. This session is worth 0.5 continuing professional education credit. To be eligible for CPE credit, you must answer at least 2 polling questions during the session and have a total viewing time of at least 25 minutes. In accordance with the standards for the National Registry of CPE sponsors, CPE credit will be granted based on a 50-minute hour. FEI is unable to grant CPE credit in cases where technical difficulties disqualify eligibility. CPE program sponsorship guidelines prohibit issuing credit to those not verified by the session data to have satisfied the minimum requirements. At the conclusion of this session, your CPE certificate will be made available for you to download in the CPE certification window should you meet the criteria. A link to download your CPE certificate will also be included in the thank you for attending email sent within the next 24 hours. Below the resource list window is the Ask Your Questions Here box. Please feel free to submit your questions to the speaker throughout the presentation, and we will answer as many as possible. It's now FEI's pleasure to introduce FEI Houston Chapter President, John Briscoe. John?
Thank you, Michelle. I'm John Briscoe, President of FEI Houston, and welcome to our next session. Our next speaker is Greg Milano, Chief Executive Officer of Fortuna Advisors and author of the new book, Curing Corporate Short-Termism, a great book for senior managers who want to encourage more investment in the future of their companies while maintaining financial discipline. Now, I will hand it over to Greg Milano. Greg?
Thank you, John. Thank you for the nice introduction and for plugging my book. I'm going to be talking today about allocating capital in the new decade, which really has 2 facets to it for those of you who are listening. The first is traditional thinking about allocating of capital and resources to where value is created in order to try to drive the overall value of an organization higher. And then the in the new decade part means I'm going to talk a little bit about how to think about value creation in an environment where traditional financial measures don't always provide the right signals. And hopefully you'll find both aspects of it engaging as I go through this. I'm going to mostly take questions at the end. I think it'll be smoother if I kind of go through my flow as planned and then take questions at the end. And if I don't get to all the questions, feel free to reach out to me. My email's on my website, fortunaadvisors.com, and I'm happy to field as many questions about this topic as people have. I'm going to start by talking about value creation in terms of top quartile total shareholder return. Companies sometimes think, well, I'm not in a very sexy industry, so it's hard to be a top performer in terms of share price performance. But this graph shows the last 5-year ranking of TSR relative to other companies in the S&P 500 on the vertical axis, and on the horizontal axis is the 5 years immediately preceding that. As you can see, it's a virtually unrelated cloud of data, and so where you are in one 5-year period tells us nothing about where you're going to be in the next 5-year period. The good news is that fact that past performance is no indicator of future performance means it's within everybody's purview to aim to try to be top quartile, and we think every company should set aspirational goals of trying to be top quartile. One of the benefits of doing that is it causes you to think more outside the box to try to figure out how am I going to get there versus what a lot of companies do, which is to just do incremental, sort of marginal improvements off what they're doing now, extrapolating into the future without really thinking outside the box. And as a reference point, top quartile TSR is roughly equal to doubling your share price once every 3 to 4 years, depending on the company. Top quartile is a very important thing to aim for, and the size of the prize is huge. For most companies, being top quartile in terms of total share price performance over the next 5 years versus being average is a difference in market cap 5 years from now, roughly equal to 75 to 100% of today's market cap. So that's a big difference between being top quartile and not. And so aiming to be top quartile and thinking about strategies and tactics to help you get there is really a very worthwhile thing because, again, the size of the prize is huge. Before I go any further, I'm going to ask a simple poll question. And after I ask the question, I'd like you to select yes or no, and then please click submit I'll give you 15 or 20 seconds to answer the question after I finish, and then I'll go to the next page and we'll see the results. The question is, do companies that act with high corporate purpose deliver better results for shareholders? And again, select yes or no, and then click submit in order to have your selection recorded. I'll give you a few more seconds. Please click submit after you've made your selection. Okay. Now, 90% say yes, so that's a crowd that maybe knew where the answer was going, or maybe you all firmly believe that. But research that we've published clearly confirms that point. And the reason I like to put this right after all the TSR talk is that in order to create value for shareholders, you really do need to create value for other constituents by operating with high corporate purpose. In a report that we released a few months ago in collaboration with the CEO Investor Forum, which is part of the Chief Executives for Corporate Purpose organization, we studied companies rated by the public as operating with high purpose, and we compared them to companies operating or perceived to be operating with low purpose. And what we found was the companies perceived as operating with high purpose produced meaningfully higher average returns on capital, were valued at meaningfully higher valuation multiples, and delivered very much higher total shareholder return. It's very important to know that in order to deliver total shareholder return for shareholders, we need to really be operating with good purpose and caring about all stakeholders. The two are very well related. The next topic I'm going to turn to are my 10 key principles for effective capital deployment. And John gracefully mentioned my book, which came out earlier this year. It's called Curing Corporate Short-Termism. And within the book, I list and explain these principles, but I'll go through them quickly here to set the stage for the rest of what we're going to discuss. The first principle is the top priority is survival. Before worrying about how we're going to create value, we need to survive. And this event is sponsored by the FEI chapter in Houston. And obviously, there are a lot of companies there to operate in the energy industry. And so it's important for them to worry about survival because commodity prices sometimes move in mysterious ways. And you can think you're in a growth pattern, and all of a sudden, months later, you're worrying about your survival. So making sure that you're not taking undue risk on your balance sheet or in your operations is important to make sure that you can survive, because if you don't survive, you're certainly not going to have top quartile TSR. The second principle is buy low and sell high, which everybody thinks is just a cliche, but we want people to really do it. We want people to really think about making acquisitions when they're cheap, not when the market is at a peak. And we want, if somebody's going to divest an asset, think about doing that, when the value of that asset is high. So you can think like an investor and act like an investor and provide more benefits to your shareholders. Principle 3, don't follow the crowd. If you think about all the companies in an industry suddenly deciding to invest in a certain thing, that certain thing becomes expensive and probably becomes less effective because everybody's doing it. It's good to pay attention to what you learn about what others in your industry are doing, but sometimes it's important to think carefully about being contrarian when that's feasible in order to take advantage of buying opportunities when assets are less expensive and being able to then seize opportunity with them when they come into vogue. Principle 4, investment usually outperforms financial engineering. Financial engineering, through fancy ways of trying to drive earnings per share up beyond what the underlying economics of the business can justify, tends to only result in a declining price to earnings ratio and not really a lot of value creation. Investment in the business and operating the business tends to outperform financial engineering. Fifth is prioritize organic investment. An advanced note, Principle 6 is going to be about acquisitions, which on average do create value in accordance with our research, but prioritizing organic investment should come first because it usually creates more value per dollar of investment. And as I mentioned, be willing to grow carefully by acquisitions. In many industries, we've shown that the more acquisitive companies have better share price performance than the less acquisitive companies. Of course, we all know of some pretty spectacular disasters with acquisitions, so be careful. And don't be afraid to shrink through divestitures or spinoffs when that's the best use of your time in order to free up resources to invest in better parts of your organization. Principle 7, leverage tends to stifle investment. For those of us who took corporate finance classes in school, we learned about the weighted average cost of capital, and that being more leveraged tends to reduce the weighted average cost of capital because of tax shields. That is supposed to drive the value of a company up, but our research shows that on average, through up and down cycles, high leverage tends to lead to less revenue growth and lower total shareholder return. And we believe that's because when you take on the risk of leverage, you tend to be overly conservative about investing in the future. And so although the leverage might actually reduce the cost of capital, which increases value, the operations don't perform as well when you're burdened with heavy leverage because of people being overly conservative. Principle 8, implement buyback execution rules. For companies that typically do buybacks, when we look at them, we often find they buy back a lot more stock when their stock price is high and a lot less when their stock price is low. And that's not very good for the remaining shareholders. They would be much better served if you use buyback execution rules to have fact-based signals as to when you should be buying back more stock and staying out of the market when you shouldn't be buying back stock. That way you retire more shares and you leave more value for the remaining shareholders. Principle 9, dividends are value neutral, and we've studied this many different ways. I know there are a lot of people that disagree with it, but on average through a cycle, dividends are value neutral. They are an effective means of distributing cash if you have more cash than you can reasonably invest in your business through a cycle, but don't expect them to lead to any sustainable improvements in share price performance. They don't. Principle 10, and this is a really important one, value creation is hard work. There are no shortcuts, there's no easy path, there's no free lunch. Putting in the time to figure out where your business creates the most value, putting your resources there, and then operating in a way that really drives success takes a lot of hard work, a lot of hard thinking, and a lot of hard execution, but it's worth it, as discussed before, under the size of the price. The next poll question is, how much of the aggregate market cap, or actually the enterprise value is the way the next page will be worded, is represented by the book tangible and intangible assets of a company? So if you added up all of the net property, plant, and equipment, the net working capital, the goodwill, other intangibles, all the key assets of a company, how much of the overall value of the business do you think is represented by those assets? Is it greater than 100%, between 50 and 100%, or less than 50%? And once again, after you make your selection, please select submit, and I will be going to the next page to look at the results in about 15 seconds. Please click submit when you're done. And we have about 55% of people said less than 50%, which is correct. A few people said more than 100%, and the rest were in the 50 to 100% range. One of the figures in my book is shown on the next page. And as of that point in time, which was based in the late 2017 time period, the total tangible and intangible assets represented about 30% of the enterprise value of companies. And the value premium on top of that was the rest of it. And so the question really is, where does all that value premium come from? And it comes from creating value on top of the assets you put in place. It's the net present value, if you will, that we learn about in the corporate finance textbooks. And it comes from creating differentiated intangible assets, whether they're brands that have value, they're technologies that have value, they're a captive supply of some resource or what have you. Something that gives you a differentiated competitive advantage and allows you to create meaningful returns on capital or returns on resource investments is what drives that value premium. And so the rest of the story is going to be about trying to find ways to allocate resources to where they create the most value premium. That's really what strategic resource allocation is all about. And we talk about resource allocation, not just capital allocation, because in the modern world, it's not just about traditional property, plant, and equipment investments. Investing in brands, investing in R&D, even investing in our people, investing in our supplier network, our logistics. Investment oftentimes comes in the form of things that are expensed by traditional accounting, but if they have important multi-year benefits, they are investments. Now, when we look at most companies, as is shown here in this graphic, they often just sort of smear the resources across the range of different places to invest, regardless of how much value is being created in different areas. To think and act like an investor, what you need to first do is to figure out where you're creating the most value. In this case, it's business unit A, business unit B, business unit C, and so forth. And you want to disproportionately allocate resources on the left side of this page rather than on the right side of the page. Now, many companies that we work with don't do that very well. Again, they smear the resources across the organization. In some cases, they even invest more in their worst value creation opportunities, often because they're focused on traditional accounting profits instead of value. Imagine if one of your business units was Amazon in its early days. Would you have had the wherewithal to invest enough in that business to create anywhere near the value that they've created on their own? Would your measures have shown that that was a value-creating prospect? In addition, companies often have too short-term of a focus where they emphasize quick wins, quick growth implications, quick cost-cutting implications, rather than investing in the very brands and technologies and other sources of differentiation that are going to create sustainable performance results and really drive the value that we saw on the prior page. I'm going to go on to the next page now, and we're going to talk about operationalizing strategic resource allocation. And once again, I have a poll question. How do we explain Amazon's share price trend? And there's three possible answers here. The company has duped investors. You don't need profit if you grow fast enough. Or third, Amazon delivers valuable results. Please select your answer and then click submit. I'll give you another 15 seconds. Remember to click submit after you make your selection. A few years ago, almost nobody answered with the third answer, but people are starting to realize they really do create value. Not everybody's sure how to measure that, but they're pretty sure they really are creating value. Our performance measure, which is described in detail in my book, is called Residual Cash Earnings. It's a cash-based economic profit measure. If you're familiar with economic profit or EVA, this is a cash-based version of that. Gross cash earnings is really just like EBITDA minus the tax that you pay. The capital charge is the required return or cost of capital, however you'd like to refer to that, multiplied by the investment, but we use gross investment. Since we don't charge for depreciation, we add back the accumulated depreciation in the asset base, and we get a measure of cash economic profit that actually tracks total shareholder return really well, better than other measures, a lot better than traditional measures. On the right side of the page, what you can see is that in every single industry, RCE relates better to TSR than traditional economic profit or EVA. And the last thing I'll point out on this page is if you look at the bottom box, RCE encourages value creation by encouraging people to invest in all opportunities that deliver returns above the required return, to improve margins, capital productivity, and just generally run businesses better where you don't need to make new investments. And lastly, by harvesting investments that offer far too little value potential so the proceeds can be used to invest more in better opportunities in the rest of the organization. I mentioned Amazon in the polling question. The right-hand graph shows that a valuation of Amazon using RCE, simply capitalizing the period-by-period residual cash earnings, adding it to the asset base, dividing by the number of shares, gives you a share price that actually tracks the actual share price very well. And interestingly, after this was produced, we updated our Amazon model, and using the latest estimates for 2020 EBITDA, the predicted share price and the actual share price are right in line right now, within a few percent of each other right now. And as you can see, we've tracked Amazon's share price all along. Amazon is a modern company. They don't produce a lot of accounting earnings, although a little more now than they used to. But the value that they create shows up in the return on investments that are often investments that are expensed on the P&L, massive investments in R&D, lots of depreciation on assets as they build out their logistics and delivery network. And if you adjust it to a cash basis and you treat those P&L investments as investments, we track Amazon's share price almost perfectly. So in the modern world, a metric like this residual cash earnings helps you better figure out where you're creating value so that you know where you should be putting more resources and where you shouldn't be. The next page shows us an example of an actual client example. I'm only going to focus on the graphs here as I did on the last page. The left-hand graph is what it looked like when we got there. The vertical axis is what we call the reinvestment rate. It's how much of the cash flow a business generates and then redeploys back into the business. So 50% reinvestment rate would be 50% of the cash flow you generate gets plowed back into the business. 100% would be 100% and so forth. And then on the horizontal axis, we're looking at the present value of future RCE as a percent of the investments that are planned for in that business. And what you can see here is that on the right side of the page, on the right side of the graph, we have a lot of value-creating business units with very low reinvestment rates. On the left side of the graph, we have businesses that don't create value. In fact, many of them are reducing value with RCE going down, where we have higher reinvestment rates. And it's almost like we want to deliberately pick the stocks that are going to go down and not pick the stocks that are going to go up. When we got done with strategic resource allocation, we ended up with a graph like the one on the right here, which is not a perfectly straight line because obviously every business has different ability to actually invest in the business, different needs for sort of short-term investments for maintenance reasons and so forth. But you can see the slope is now up, generally higher reinvestment rates on the right side of the page, lower reinvestment rates on the left side of the page. And for every $1 billion that we reallocated in this process, the NPV of the business went up by $3 billion. The return on investment was enormous by reallocating resources away from the businesses that were destroying value and toward the businesses that were increasing value. Next poll question: can value-based incentives align better with TSR than traditional incentive plans? Yes or no? I'll give you about 15 more seconds. After you select your answer, once again, please click submit. Okay, please click submit. Yes, there's a very strong relationship between the way you motivate people through incentives and the results that you get, and value-based incentives based on measures that actually measure value well, like RCE that we just looked at, tend to drive behaviors that create a lot more value. They align better with TSR, and so, if you give people a sales incentive to sell more, they sell more. If you give managers an incentive to create more value, they create more value. It's really not a mystery of how to encourage behavior. I'm only going to focus on the graph in the middle of the page here. This is an example from a client of ours where we studied the company and their peers over a 10-year period, 120 data points. And on the left side, 6.4% is the difference in median TSR between the situations where a CEO was paid more than their target bonus in their annual incentive plan versus the median TSR when a CEO was paid less than the target bonus in their incentive plan. So a positive relationship is good. The managers that were paid above target bonuses had median TSR 6.4% higher than those paid below target bonuses, which is good. But we then went back and simulated our incentive plan based on RCE. And all we do is we measure RCE versus the prior year. When it goes up, it's good. When it goes down, it's bad. It's that simple. We don't need to have budgeted plans and so forth. We just measure against last year. And when we now looked at the situations where we would have paid above target and took the median TSR of those years, and the situations where we would have paid below target and took the median TSR of those years, the difference was 14.9% TSR per year. And so that's a much stronger relationship to value. And as we often say to people, if you use this kind of an approach for all the business units of a company, it's like giving each business unit management team an incentive based on their own TSR. Even though we don't have a market value for that business unit, RCE relates well enough to TSR and motivates value in the right way that they're going to be encouraged to make the right decisions to create a lot of value. My last page is a case study based on a company, Varian Medical Systems. They're the largest producer of radiation therapy equipment for treatment of cancer. We worked with them in 2017. Over the next 3 years, they quadrupled their revenue growth rate, and they pretty much doubled the share price from the period right before we started working with them. The middle graphics are from their own Investor Day presentation last year, where they talked about creating an ownership culture, decision-making that's improved with this measurement approach, how to balance the short and long term, and that the measure was really a true value driver. And we have a few articles, one in the FEI, for example, published with FEI, that talk about this as a case study, and I encourage you to look into it because it's a really good example of really how to create a lot of value. So what I'm going to do is I'm going to look at Q&A and see if there are a couple of questions here maybe that I can answer. Okay, the first question I'm picking is one that says, if my company has had a poor TSR performance, what are the first 2 to 3 initiatives you would most probably take to turn around the company? The first thing I would do is I would implement a new value measure to give people a better sense of what they should be doing to create value. And then using that measure, it would help me to diagnose where I'm out of line with best-in-class performance in my industry. You know, maybe I need to streamline my working capital. Maybe I need to better utilize my capacity. Maybe I need to invest more in R&D or brand-building marketing in order to create more differentiation and create more of a runway. But it all starts with getting a focus on value so that people understand where they're creating value and where they're not, and they can really have clarity on where they should be focused. Okay, the next question has to do with balancing maintenance projects with growth projects. And what's interesting is that when you have a low reinvestment rate, a majority of the investment is maintenance, and you don't have much growth. As you increase the reinvestment rate, you tend to have more of a proportion of growth projects. Maintenance projects are unavoidable in many situations, but still using economic analysis to try to find the most cost-effective way to do those maintenance projects can help you constrain how much you need to spend to properly maintain your assets. And then devoting money to growth projects really should be about investing in everything that meaningfully beats the required return on investment. And many companies, unfortunately, artificially create a budget, and then they start with that, and so it's a big debate between the two. But as long as you don't have a debt constraint, as long as you're not over-levered, you should be open to the idea that if I have lots of value-creating growth projects, I should be pursuing many of them. Let me answer another one here. Yes, in a cyclical industry, again, many people from Houston operate in cyclical industries, and I know this is open to people from other places as well. But in cyclical industries, we can't avoid the up and down of the industry, commodity prices, what have you, that drive that cyclicality. There are ways to try to structure contracts to pass some of that through to people to try and offset it somewhat, but often there's a limit to how far you can push that. But these principles still work in a cyclical industry in order to try to get each peak to be higher than the last peak and each trough to be less bad relative to the last trough. You need to do a little more smoothing of how the incentives operate over time in order to offset some of the up and down balances. But our focus on continuous improvement really helps, because after a downturn, where you may have been whacked in your compensation, that's a technical HR term, the focus on continuous improvement means as soon as you start turning in the right direction, even just stabilizing, you start to get target incentives again, and as you start to go back up the cycle, you can start to get improvements. I'm going to take one more because I'm almost out of time. Let's see here. I'll pick somebody else who I've not answered a question from before. Is high corporate purpose the same as ESG? ESG is an important part of operating with corporate purpose, but it's broader. As you think about all stakeholders and all the things you do in order to do good things for your various different stakeholders, that can all be wrapped together in terms of corporate purpose. When you think about a company as a consumer, and you think about what they stand for, and do they have the same kind of values and ideals, and do they practice them the way I do, and so forth, I think corporate purpose is a broader type of topic than just ESG, although ESG is obviously a very important part of it. With that, I think I'm just about out of time, so I'll stop with the questions. And thank you all very much. I appreciate it. And again, if you'd like to reach out to me I'd be happy to field questions if you email me. If you go to our website, Fortuna-advisors.com, my email contact details are there. You can reach me anytime. Thank you all very much.
That concludes this session. Our next session will begin at 5:05 p.m. Central. Look for the pop-up window in the upper right-hand corner to bring you back to the conference hub for your next session, and we look forward to seeing you there.